Good morning, everyone. This is our monthly lender interview, and today I have Karla Kyte with me, and she is from CrossCountry Mortgage. And her and I have gotten to know each other just in the last probably 6 months or so. But I just wanted her to jump on here today and give us an update on what's going on in the market as far as interest rates, what she's seeing, and we'll just have a conversation about that. So, welcome, Karla.
Good morning, Carol. Thank you so much for having me on today. I'm really looking forward to this.
Yep, very cool. Okay, so I know that's what everyone is asking. We have the election coming up and we haven't really seen a big drop in interest rates. So just talk to us about what you're seeing currently just in August in the market right now.
Yeah. So, I mean, honestly, we are, I think, seeing a lot more inventory. That's more your lane. I think that's just kind of speaking to what's going on. I will tell you that it seems like it had been really slow over the last like 6 weeks. But wow, we have really started to pick up. Last weekend was much busier than we thought. Interest rates are coming down. They're just coming down very slowly.
Okay.
And to be honest with you, if they came down fast, we would be, back in the turmoil of what was it? The spring of 2022, was it? When it was super crazy and people were offering way over, and
Yep.
that's not healthy for us either. So,
Yes, you're absolutely right. Yep. So
yes.
currently, like for a first-time home buyer that's looking to get in on an interest rate, what is the interest rate currently? And I know you've got different types of loans and all of that, and it probably varies based on their credit score and all those things. So just
Yep.
talk to me a little bit about like first-time home buyers.
Yeah. So that's a very loaded question, just like you said, because there's so much criteria that you have to meet when we're pricing out a loan. And we're not trying to be secretive about, our rates or anything like that. It's just that depending on what program you qualify for, if you're going into Fannie Mae, Freddie Mac, FHA, VA, those rates are going to be very, very different. And they're also going to be very different based on your down payment and your credit scores. But I will say, with that said, I would say that our government loans, FHA and VA, we're pricing down in the fives. And everything does, of course, depend on what you also want to pay for that interest rate. I think typically when we're talking about a first-time home buyer, we're talking about people that don't have deep pockets and don't have a lot of money to put down. But that's not always the case. Being a first-time home buyer just means you haven't owned a home for 3 years. So,
Correct. Good
it
point.
depends on a lot of what is going into this. But, for our FHA buyers, which I mean, VA is about the same, but you have to have VA eligibility to use VA. So anybody can use an FHA loan. But the rates are really great on FHA. Conforming is a little bit higher. We're still, in the sixes. And again, that depends on if you're using a Fannie Mae or a Freddie Mac loan and you can meet first-time home buyer criteria, which is you haven't owned a home in 3 years, then you're exempt from some of the fees that a person who is not a first-time home buyer would be paying that go towards the interest rate. So first-time home buyer status is a huge benefit. Um, Also, if you're under the income limit for the county that you're in, that's deemed by Fannie Mae and Freddie Mac, you can also avoid some of those higher hits to your interest rate.
Okay.
So you have to look those up per county, but like for example, Denver County, I think is 130,000. So if the income that we're using for qualifying is under that, you can qualify for a little bit lower of an interest rate.
Okay. So
Yes.
how do you know that income? Is that your net? Is that what you claimed on taxes? What is that income?
Well, so for a self-employed person, it would be your net. So it's what you're claiming after your write-offs. But for people that are employed, it's the income that we're using. And so, like a little trick sometimes that we use is sometimes we can get somebody in under that line if we're only using their base employment and not any overtime or bonuses or anything
Okay.
like that. But then it's like, it can go both ways because sometimes we need that bonus income to qualify them, period. So it's all based on the income that we have to use. So like sometimes if we have a couple and they are very, very well qualified, um, if we can remove one of their incomes and just use the one employment to qualify so that we can keep them under that cap to
Yep.
benefit from the rate, we will absolutely do that. But the prices of our homes are really high, so it's difficult to do that.
Right, right. Okay. That's
Yeah.
great information. And I love that you pointed out first-time home buyer is somebody who has not owned a home in 3 years because a lot of people don't even think about that. So,
Yeah.
yeah,
Yeah. And
that's
that's ownership. So if you're on the title of a property, you own it. Now, there is one way you could be on the title of like your parents' or your grandparents' home. And if you're specifically on, I can't remember the way that you would be on that, but some people put their kids on their homes.
okay.
And that you might still qualify as a first-time home buyer, even though you've been
Okay.
added onto the title of your parents. So that's a gray area we would have to look into.
Okay. Karla, that is great information. Thank you so much for sharing just all of that about first-time home buyers, the different programs, how you take income and you can adjust it to get your clients the best interest rate and the best program for them when they're getting a mortgage for a new home. So, really appreciate that. Another area that I wanted to jump into, and I know that you are a certified divorce lending professional. And you've been doing that now for, I think, 6 or 7 years. That's primarily who your clients are. So I wanted to talk about that a little bit. You've got two people going through a divorce. Let's say they have two homes and they're both on mortgage to both homes. They have extremely low interest rate. They don't want to refi. What can they do? Like, for instance, if one's keeping one home and the other's keeping the other, what can they do to protect themselves against the other person not like missing a payment and that affecting their credit score since they're both on both mortgages? Is the loan assumable? How does that work? And just talk to us a little bit about that.
So really, so the first, are those loans assumable? And if
Okay.
they are Fannie Mae or Freddie Mac loans, you will see in your closing disclosure package that they're not assumable. But
Okay.
you need to call the servicer and ask them if you are able to assume this loan in the case of a divorce, because I am finding that almost every single investor is allowing for a full release of liability, which is basically an assumption, only in the case of divorce. So you have to be asking the right questions.
Okay.
Right. So if you don't say I'm getting divorced, they're just going to say no to you because you don't have an assumable loan. If you had an FHA or a VA loan, yes, it's assumable, and we can address that topic another day. But for you guys, if your loans are assumable, that's the first step.
Okay.
The second step then would be to make sure that during your divorce process, that you're setting yourself up properly so that you can each qualify to assume those loans. So, for example, like
Okay.
you're self-employed. So
Right.
we would want to look at your self-employment and make sure that you qualify. If you don't qualify, then maybe we want to look at, I don't know if you're going to be getting any maintenance support from your soon-to-be ex-husband, but if you are, we want to make sure that that maintenance is going to be paid out to you properly so that you will qualify.
Correct.
Um,
Talk
yep.
to
And
us a little
then,
bit about that because this is all has been new to me in the last year and a half, and I have learned so much information. Like, you can't like give me my maintenance into our joint account. It needs to be paid to me separately.
yep,
So
yep.
talk about that.
Um, Needs to be prepaid to you separately. Well, not prepaid, but paid separately from a separate account. It needs to be paid monthly and paid on time. For us to be able to count it, you have to have received it for a certain period of time, and it has to continue for at least 3 years past the date that we would close on the loan. So I offer divorce mortgage planning services as on the side. And so that's exactly what I do. I work with clients going through divorce to make sure that what they're agreeing to in their settlement is actually going to be beneficial for them in qualifying for a mortgage. Because there are so
Yeah.
many agreements that are made that are not they don't fall in line with guidelines. Like it's legal. Like everything that your attorney is helping you through and helping you do is completely legal and might make perfect sense. But then when it gets to my underwriter, it just
Right.
doesn't work. So,
Yeah, so that is a huge thing. So,
mhm.
as we go forward and do these monthly, I'm totally going to dive in with you a little bit more just about how that looks. I'm sorry, someone's in
Yeah,
my throat.
that's okay. Yeah. Well, and I just want to say too, really quick, I've had my certification in divorce since 2017, and it has it has become more difficult, extremely difficult for my divorcing clients to figure out home ownership just in the last 2 years because interest rates spiked, home prices spiked. So it's just not as easy. I mean, on the upside, because of the cost of housing spiking so much, they have a lot of equity in their homes. And so, I mean, in most cases, people are selling and just separating that equity and purchasing new homes at a lower price point. Um, but it's been like this market has been really, really hard on divorcing clients, really hard.
Yeah.
So helping them through that, I mean, that's what I do. And yeah, it's that fills my cup.
Yeah, and you're a great resource for that. I've learned so much from you just over the last year or so that we've known each other. So thank you so much for being with us today and giving us some information. And
You're welcome.
we will definitely get back together next month and we will talk a little bit more about just things that are going on. So,
Awesome. I'm so
so
looking
much.
forward to each one of these. Thanks, Carol.
All right.